Over the past few months, I know that the stock market has increased a lot. So there's these questions that people always ask. Market went up so much, should I still continue to buy? So in this video, we'll go into the details to give you some ideas on what I'm thinking at the moment. So let's take a quick review on the market situations now. So as you can see here, S&P 500 has moved up by 20% this year. So it's a huge rally as compared to last year where the market dropped by about 20%. Then for those who follow tech stocks, QQQ has went up by 45%. I think my portfolio is similar to QQQ. That's why it also went up by similar percentage. Later I will give you more details. Then on iShares MSCI China, you can see that this index has been struggling for quite a while now, but even so, it is now just break even for this year. On Vanguard Total World Stock Index Funds, you can see that the markets also went up by 16%, which is slightly lag US market, but not far behind. So this is the performance of my portfolio. As you can see, Nvidia, after the huge run up, now it is the largest positions in my portfolio. It used to be, in number 5th of 6 positions, but now it is the largest, followed by Apple, Amazon, Microsoft, TSMC, Tesla, and Google. So you can see that my performance is 47% year to date. This is around end of July 2023, and it outperformed S&P 500 and also the world ETF. I'm glad with this kind of performance, but you need to remember that actually in 2022, the performance wasn't that great. And I suffered like a 6 digits loss last year, but this year the portfolio has been doing quite well. So the question that we are asking is, market went up so much, can still buy or not? So I think this one, many people heard about the quote from Warren Buffett. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. The questions that we are interested to know is that general markets, the feeling is fearful one or is it greedy one? In my opinion, it is closer to the greedy mood now because many people are starting to get FOMO. When it comes to sentiment, sometimes it's not so easy to just base on gut feel, right? We also should look at some numerical numbers to give a comprehensive view on the situations now. So I will go into more details on the valuations. This chart is showing the S&P 500 index versus the different valuations multiple. As you can see here, around end of 2022, the index has performed badly and the valuations was relatively cheap at around 16 times forward PE. Since the market recovered, now it is closer to 20x PE. If you ask me, is this level is super overvalued? I think the answer is no, because if you just have to look back to 2021, it has been above PE of 20x for quite some time. So at 20x, I would say it is slightly overvalued, but not like a bubble type of overvalued. But of course, for those who pay a lot of attention to valuations, some people might say they are not comfortable to buy at 20x PE. They might want to wait for the PE to drop to 14 times or 16 times. I think that's reasonable. Different people just have different risk appetite when it comes to the entry points. I think this one, you just have to decide for yourself what kind of valuations that you are comfortable with. Okay, the previous chart is showing the PE of the entire market, but if you look at different asset class and look at the sub-asset class, you will notice that some asset class actually move up more than the rest. So we can look into more details here. As you can see, US growth on the right hand side here. If you look at these two colors, the light green one is the valuation as of end of 2021. This was the period when the valuations was rather quite high, and the dark green is the current valuations. US growth valuations has came down a bit, but relatively speaking, that means compared to the historical valuations, it's still quite expensive. And same for US large cap, also expensive. But if you look at other asset classes towards the left hand side, you will see that actually some of this asset class isn't that overvalued. So for example, US value, it is quite close to the historical mean, and US small cap is like really at the historical mean. And if you look at other markets, for example, like emerging market equity, developed market equity excluding US, they are all, in terms of the valuations, they are even cheaper than historical mean. And if you pay attention to treasuries and US core bond, these are fixed income asset class. Actually, right now, the valuation is quite attractive. It's not expensive to buy now, given that the interest rate is rather high as compared to the low interest rate environment over the past few years. So now let's look at the corporate revenues and earnings. So as you can see here, this is S&P 500 revenues per share. I mean, compared to 2021 and 2022, you can see that the revenue per share has came down a bit in terms of the growth, but it's still growing, meaning that compared to 1 year ago, we are seeing that the revenue is going up. So this is definitely a good thing, because when corporate revenue started to comes down, that's we're talking about like recession scenarios, which happened in 2020 during COVID periods, and before that it was around 2015. The next one is S&P 500 operating earnings per share. Operating earnings per share, we started to see some slowdown over the past 2 quarters. You can see that 2021, this is the period where the economy is recovering well from the COVID periods. Hence, you see like a huge green bar here. Subsequent after that is that we see that there's some normalizations of the corporate earnings. So I think I've listened to a couple of earnings call. I think people are asking management like when do they foresee to see that pickups in the earnings. So I think generally speaking, I think most of the comment is saying that around end of this year or early next year, they foresee that the economy and earnings will starting to go up. So that's at least the general consensus. But this is just a very high level review. I think for sure, if you want to understand the companies that you invest in, you need to focus on that specific company, because not every sector is moving at the same pace. Some sectors are already like in a contraction phase. Some sectors already like move up from the contraction phase, and some industry never get into the contraction phase. So for those who look at the S&P 500 and think that, okay, now given that we are close to like all-time high, should we just like sell away our shares and then just buy back when the share price is lower, right? So you might want to pay attention to this slide, because on the left hand side here, this is showing that the S&P 500 earnings per share over time. You can see that from, let's say, like 1988 until now, generally speaking, earnings per share has been going up, because companies are growing and then their earnings more, economy is also growing and so on. The key is that what will happen over the next 3 years, because let's say if you say I just want to sell away my shares and buy back when it is cheap, right? But let's say if the consensus analyst estimates, meaning that the EPS that analysts expected are going up, right? If this materialize, what happened is that now even at the same forward PE multiples, right, we should expect that the S&P 500 index to be even higher. So for those who de-risk too much, I think the risk is that, let's say if the earnings per share keep going up, I mean, you just have to buy back at a much higher level from now. So this is something to pay attention to. Of course, this is just the analyst estimates. It doesn't mean that all these estimates will come up to be true. Say, for example, if there's a recession, or if the recession is like more serious than what people thought, like a soft landing, of course, all these may not materialize. And of course, if you are playing on the safe side, you can gain from buying at a cheaper level. But I'm saying that it's not a sure thing that given that the price is at close to all-time high, definitely it will come down, right? So I think this is something that you want to be aware of. If we look into more details, for example, like where are the sources of the earning per shares, right? So basically, there are mainly, you can say there are 3 different ways they can grow. So the first one is that the revenue growth. As companies, their sales increase, of course, they can generate more profits from that. And then secondly is the margin. And then even if the revenue and margin is constant, let's say if the companies take their earnings and do some share buyback and reduce the outstanding shares of the companies, that will actually improve their earnings per shares. So these are the 3 types of breakdown that we should focus on. For 2023, the margins has been moving up. So 8.1%, at least this is the estimate. So I think this is, you can attribute this to some, efficiency gains because companies trying to cut costs. I think this is one of the major reasons. And of course, with all this margin and revenue still on the positive, right, they are increasing. The total EPS also increased 10.8%. At least this is the estimate as of now. So we don't know what's going to happen in, the actual value of 2023 and also 2024 and moving forwards. But generally speaking, if you look at the long-term trend, companies tend to increase their revenues over time. Margin tends to be healthy, especially for the companies that are keep winning, keep like satisfying their customers. So for those who are on an optimist camp, you can be reasonably expect that all these things should continue to check up over time. So again, for those who pay too much attention to like short-term movement, for example, like S&P 500 went up by 20% in just like 7 months, right? So I think this is for those who focus on the short term. You might think that, oh, this is like a huge movement, but sometimes I think it's worth for us to spend some time to like zoom out and see the entire movement of the index from 70, 80 years from till now. So you can see that if you just plot a straight line, right, like a regression, you get almost like a straight line on a logarithmic chart. So, and if you can see that 2022 drawdown, I mean, if you zoom out, you can see that actually it's nothing much here. It's like same magnitude as what happened during maybe 2020 and maybe some other period prior to that. But generally speaking, as long as companies' earnings continue to go up, revenues go up, margin is okay, I mean, S&P 500 index should be expected to go up over time. So for those who play too much timing, right, especially for those who say, oh, let's sell now and let's play the market timing game, right, just remember that you are actually betting against the trend, the long-term trend, which is up, right? So please pay attention to this. Then another thing to remember is that if you compare different asset class, right, stock market is still the asset class that give us the highest returns. For those who look at comparing different asset class, stocks, bonds, bills, gold, US dollars, for those who just continue to save in dollars, right, there's no asset class perform as good as stocks. And this one, if you look at the history from quite like 200 years ago until now, I mean, it's not just the magnitude of the returns, but the consistency of the returns over time is like very, very high. It's like it's almost like a straight line over the log chart here. So that's why I would say for those who are in the like the optimist camp, right, you are just betting on the corporates is going to do well. They're going to increase their revenues and earnings over time. We are all going to do well. We don't have to play all these market timing games like need to sell high and then buy low later. Of course, this is like very attractive for those who are able to get some short-term returns. Say for example, you sell now, then there's a 3% and 5% kind of drawdown, then you buy back. You just play this kind of game. Sometimes you get some short-term profit. I know it is very satisfying to play this type of game, but I think for those who are in the market for sufficient long period of time, you'll notice that actually there are a lot of games that we don't have to play. We just need to be patient, stay invested, and then let the money, let our capital compound for us. As long as you just continue to DCA over a long period of time, it is very hard to beat this kind of returns. Even if you just get the average market returns, right? Say about let's say call it 8 to 10%, right? As long as compound this over quite like 10 years, 15 years, 20 years, you are going to get a very good results from here. So your retirement is set. So I think depends on everyone. Different people want to play different game. But I'm just saying that for those who focus on the long-term investing, we are all fine, even though we don't play this kind of market timing games. Okay, the next one. Now, because we talked about just now, market is not really cheap. So sometimes I think worth to pay attention to if we don't invest in the stock markets, right? We might feel that okay, it's a bit of the overvalued side, and I still have some saving. I don't want to put my money into stock market at this kind of valuations. Then you can think of what are the alternatives, right? So good thing about current period relative to period during low interest rate environment is that now actually we have a lot more alternatives, which I would argue that is fairly attractive. Say for example, for those who are based in Singapore, right, the Singapore T-bill is currently yielding about 3.9% for 6 months yield. So what it means is that you can just lock in your money in 6-month T-bill. You get 2% in 6 months. So I think this is quite attractive, given that now we don't have any plan for that capitals, right? We can just okay, why not I just get the 2% for that 6 months and reassess again, see 6 months later what should I do, right? So I think this is a good alternative. But please be mindful that Singapore T-bill might not be very liquid, so it might not be so easy to sell. Let's say if there's a market small market drawdown over the next 3 months, you want to sell, it might not be that liquid. So I think for that, right, some people will be attracted to, just put their monies into some form of deposit. Say for example, this is GXS. They are currently offering 3.48% per annum, which I think is quite attractive because your money is not tied up. They actually credit interest on a daily basis. You can put your money there up to 75,000. Then you can just take up whenever you need the monies, right? So I think this is also quite attractive now. So as for me, I have started to put some allocations of my deposits into GXS. Mainly it's just like given that the market is quite overvalued, so I don't want to save for every dollars of money that I save. I don't want to just put all of them into the stock market. I still investing, but some portions of the money actually I put into this kind of deposits just to for asset allocations purposes now. So yeah, come back to this is that I'm still investing, but for those who followed my interactive brokers, I might not have so many transactions this year because I'm slowing down on my investing. But when it comes to other accounts, right, say for example, I have an Endowus account. So this is just set the rules. Every month they will deduct the monies from my account and then just deploy it. I don't have to do anything. Sometimes over a long period of time, I also think that this kind of accounts, right, they actually help us with the discipline. I don't have to do things and just let the games or the rules that I have set up earlier and let it just run, right? So as of now, I have about I think $26,000 in this account, and mainly I'm investing into using my SRS money. So I think this is quite attractive, as in they just the consistency part is really helpful. So as you can see, the chart is all going up exponentially. Sometimes when looking at chart like this, I'm also I feel quite have a quite a good satisfaction. For those who are curious on this blip here around year 2022, this is when I changed the funds from some I forgot the previous one, but I think it's S&P 500 index fund, now transferred to Amundi fund just to get a lower cost. So, but because it is a transfer out and then in again, so they have something make the chart doesn't look as good now. So I hope that they can help correct all these charts because actually I didn't take money out of it. It's just compound over time. I think this is a good tool for those who struggle to have maintaining the discipline, right? So you can just open an account. You can use my link if you are interested. And just set up some rules that is useful for you, right? It could be as low as 1,000 or 2,000 per month, and just stay invested over a long period of time, and you can see a good results. For me, I'm deploying about 1,500 per month. So I'm just consistently with these deployments now. So again, come back to the questions, right? I think for those who are wondering should I stay away from the market, should I sell or not? I think the idea that I try to share here is you want to pay attention to your own asset allocations. Each of us have different asset allocations. What is yours, right? So say for example, if you have too much cash now, you might want to be more disciplined and just deploy just to avoid the situation where you have too much cash and then the stock market continues just to go up and up and up, and you don't get to participate any of those gains, right? So that's something opportunity cost. It's also a form of risk. But let's say on the other hand, let's say if you already have a lot of monies invested into equities, right, and you want to set a more balanced asset allocations, then I think given that now stock market is fairly more on the expensive side, and you want to save some money in cash, then just earn the 3% or even 4 or 5% for those who get into those other even higher yielding deposits, right? So you can just set a more balanced asset allocations, put some money into deposits. I think that those are fine as well, right? As for myself, this is the chart that I just pull out from the tracking that I have, right? So this is from 2017 until now, so it's a good 6 year now. The reason is I started to track all this from 2017 is also because I bought my HDB in 2017, late 2017. So before that, it was kind of haywire because most of the money that I save actually have to use for the down payment and also for the renovations. And from 2017 onwards, this is the period where I have settled the HDB. I bought the HDB, right? So I have my monthly savings will either go into cash, go into stocks, or like also consistently I put my money into CPF, whether it's through top up and like just monthly CPF contributions, right? So over a long period of time, you can see that the asset allocation isn't like totally fixed, because I don't do like strict rebalancings. For those who know about CPF, you know that it's hard for us to do rebalancing also, right? So the mandatory contribution, you still have to do it from time to time. But what I want to show here is that actually the allocation isn't a lot different compared to like long period of times. During market downturns, say for example, like in 2022, you can see that stocks actually went down. And then during market rallies from the low of 2020s, you can see that stocks goes up. So I think this is like there's some it is affected by the market's environments. But what I want to show here is that given that the stock has performed quite good this year, even if I don't deploy much, right, and my monies are mostly in cash, but in terms of allocations perspective, actually the allocation hasn't changed as much, although the magnitude of the cash and stocks all goes up together. So I would say it's quite still a very balanced allocations. You can just treat this CPF as like the bonds, right? It's almost like the bonds, and cash also considered the safe assets. So this two is safe assets, stock is the volatile assets. I have roughly about like 50-50 into like breakdown between the safe and risky assets. To me, I'm comfortable with this kind of allocations. So let's say if stocks like there's some weakness, then I might like deploy more into stocks. If not, right, if stocks continue to rally, I put a little bit more into cash and maybe in CPF. I'm still fine, right? Because in terms of the asset allocations, it is still quite a balanced one. I just want to caution, I mean, for those who when you plot your own asset allocations, if you have like too much money over concentrated into a single asset class, right? It could be like you have too much into stocks, or you have too much into cash waiting for the market to crash, right? I think this is when you should reconsider your asset allocations and think about like what are the asset allocations that you want to have over a long period of time. Doesn't mean that you need to have 50% into stocks, because some people, they are just not comfortable with like quite like 50% in stocks. They just are comfortable with 20%. So in that case, right, then you just maintain like a 20% over time. That's good for you, right? So everyone, you just need to like figure out what was the allocations that is that you are comfortable with now. Okay, with that said, I'll say this is just a short sharing. I hope that this is helpful for you. Not much, I'll say not much analytics in this video. I just want to share what I'm thinking at the moment, and hope that you can learn something out of it. Okay, thank you for tuning in. See you in the next one. Bye bye.